Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Let's take a closer look now at our breaking news of the show. The union representing striking dock workers here in the States at both East and Gulf Coast ports reaching a deal to suspend the strike that they had been undertaking until January 15th. And let's bring in that Kate Davidson. You just heard her voice there in Scott's newscast. Kate is Bloomberg's managing editor for U.S. Eco-Policy. She joins us from Washington, D.C. So we're talking about a couple of things as I understand it. There's the wage component. What do we know about an agreement on the use of automation, though? Has that been resolved?
No, and that's a really important point to note, the language around certain protections for dock workers and what sorts of roles and jobs at ports around the country and on the East Coast and Gulf Coast in particular, what sorts of jobs would be automated. They were really fighting to preserve language and really strengthen language that would protect their jobs. Essentially, they're resisting some of the automation that's been seen in places like on the West Coast and around the world, frankly. And basically making the pitch that the companies, the shipping lines and terminal operators have reaped a lot of profits during the pandemic, and they want to share in some of that with the higher wages, but also make sure that that their jobs are protected going forward. So that's a wrinkle, an important one that will have to be worked out over the next few months.
Kate, what are we hearing about a catalyst for them to come to an agreement after just 3 days?
Well, it seems pretty clear that the White House, that the Biden administration played some kind of big role in this. They've been releasing statements, and we had been reporting throughout the week that they had been holding calls, holding meetings, issuing public statements, really encouraging, pressuring both sides to start resuming negotiations in good faith. And those talks that had been ongoing over the summer had basically stalled out in June. They didn't seem to be making much progress. But of course, we are just 1 month out from the presidential election, and the threat of a major economic disruption from this kind of strike and the ripple effect across the whole economy was certainly not something that any White House would want to deal with. But the timing, I think, was particularly bad given the looming election. So there was a big push for both of them to work something out here.
3 days doesn't seem like a lot of time. To what extent has cargo been kind of backed up? Is there a significant backlog that these dock workers are now going to have to deal with?
Yeah, so the estimates from analysts suggest, initially we were hearing that for every day that the strike went on, it could take up to a week for them to clear that backlog. Some more recent estimates that I've seen today suggested it could take something like 12 days, maybe close to around 2 weeks for them to clear that backlog. We know from tracking the ships that are basically anchored off the ports, these ports that have been closed, they were around 19 on Monday. It's now up to about 43. So again, that's just a huge backlog that will have to be slowly worked through in addition to the regular flow of goods that would be coming in on any given day. And now you have this backlog to work through. So that was sort of the risk, and the warnings about the potential impact here is that yes, it's a short amount of time, but it's really complicated to work through it once operations resume.
So I'm curious what you're hearing kind of beneath the surface, whether or not this is just kick the can down the road and, the election will happen and we'll get into January and then all this blows up again and there's heated discussions, or whether or not actually, they find agreement and that basically this deal is done. As we heard from President Scott Cowan of the Longshoremen's Association, the strike is over. Is it?
That's right. I mean, certainly it's over for now. I think that those two important words really are important for now. It's over until January 15th. But as we were just saying, it's a big hurdle to work out the issues over automation. I think that the ILA, the union leader, Harold Daggett, is going to be very tough. I think he clearly felt as though he had a lot of leverage in the situation, and definitely meaningful that they have gotten the U.S. Maritime Alliance seemingly to agree to a much bigger pay increase, something close to 62% is what we're hearing. Just Monday, the employers were offering just 50%. So that's a significant concession. I think it goes a long way toward a broader agreement. But you even heard from President Biden. He was speaking with reporters early today that he hopes it can hold. Right? There's a bit of caution in some of the statements that we're seeing from folks about the challenges that are still to be worked out here.
So, Kay, we were talking about one elephant in the room being the presidential election in November. I think it's fair to say the other is that we're in the fourth quarter right now, right? And a lot of commerce happens in this period of time. Is this critical now that the resumption of this cargo flow kind of get back up to speed because there's so much consumption that happens, or is that not an issue because they essentially front-loaded that inventory?
I think it's less of an issue for sure, right? It's true that we had been seeing some of what appeared to be that front loading. Companies and shippers, businesses were sort of aware of this looming issue, that it might not be resolved, and also aware of the potential for more tariffs heading into next year or even later in the year. So I think that probably mitigated some of it. And I also think the fact that it was apparently, that it seems to have been resolved within just a few days is definitely good. It doesn't mean that there's no impact. There's certainly some impact that will have to be worked out, but I think that it could have been much worse, certainly. No
doubt about that. So maybe we can say fairly a sigh of relief. Kate, thanks so much for making time to chat with us. Always a pleasure. Bloomberg, Kate Davidson there, managing editor of U.S. Eco Policy, joining us from Washington, D.C. here on Daybreak Asia.
One of our top stories this morning, the spike in oil prices. We've seen WTI trade up more than 5%, $73.70 a barrel or thereabouts at the moment. Joining us now in our studios for a little discussion about what is causing this and where we go from here is Ben Sharples, Bloomberg Energy and Commodities editor. So, Ben, the market has been nervous anyway because Israel has flat out said that it would respond. But then you had President Biden talking about how the U.S. was discussing whether or not to support Israeli attacks. And it has people worried now about a lot of escalation and the removal of Iranian oil. And then what else? That's the question. As you look at the markets here, you think these prices are likely to run up from here?
Well, I mean, Brian, it's, Iran at the start of the week has really knocked the oil market out of its slumber. A lot of the narrative around oil recently has been bearish, an oversupply, questions about demand. But, that missile strike at the start of the week has really set the market off. The Brent crude is up almost 8% for the week. We're looking at, the biggest weekly gain since February 2023, so over a year. And depending on what Israel does, if it does target that energy infrastructure, there's certainly a lot of room to run. So it's the what if from here and how they go about it is the big question mark.
So, Ben, what do we know about current levels of inventory? How much cushion is there were the market to be disrupted, let's say, by some type of heightened tension going on in the Mideast or, some military action?
Well, there's a lot of spare capacity in the market at the moment. A lot of ample supply. But the thing is, a lot of that spare capacity is in the Middle East, particularly Saudi Arabia. So they're pumping around 9 million barrels a day at the moment, but they have capacity for 12 million barrels a day. So there's a 3 million barrel a day cushion there. There's also the Libya is pumping more as well. So there is a lot of oil in the market, but taking out the Citigroup this week ran some numbers. A major strike would take about 1.5 million barrels a day from Iran. That is a minor strike around 300 to 400,000 barrels a day. Iran produces around just over 3 million. So it would, even though there's spare capacity in the market, it would certainly have an effect. You will see definitely a knee-jerk reaction, which could possibly, depending on what happens, if it happens over the weekend, would be a big open on Monday. But there will be a reaction, even though there is that spare capacity in the market. So I think it will take some time for it to filter through and for people to get a sense of what sort of how it's going to affect the markets. But it's going to upset a lot of people, especially a few of the buyers.
Well, exactly. I mean, China has been a country that has bought oil from Iran. Are we hearing much from China about this?
Well, as you know, Brian, China is on a week-long holiday, so we're not hearing much out of China at the moment. Yeah. But you're right. China, officially, they haven't bought crude from Iran since June 2022, but unofficially, if you look at the third-party data, they're buying a lot. They're enthusiastic buyers. If you look at September, it was probably their biggest month on record, almost 1.8 million barrels a day, and that's primarily from the smaller teapots on the East Coast, where margins matter a whole lot more for them. And China's slowdown has really crimped those margins, and for them, cheap crude, especially from Iran, is what they target because it allows them to make some money. So for China, it would become an issue. Definitely.
Yeah, we're getting ready to go into the winter months in the Northern Hemisphere. And I mean, that has got to shock energy markets when you look at things like home heating oil, right?
Absolutely. I mean, Iran has heavy and light crude, so it's a lot of that sort of oil, especially from the teapots. They are big buyers of that, so that would sort of flow on. But I think going on from what Israel does, I think what would be the reaction from Iran, and a key part of a retaliation from Iran could be the Strait of Hormuz. And if you run the numbers there, that's almost 30% of the world's oil trade flows through that strait. It's a very, very narrow strait. It's shallow. Yeah. It makes ships vulnerable to mines, to attacks from shore. So, a lot of oil coming from Saudi Arabia, Iraq, Kuwait, UAE flows through that. So if Israel attacks and then Iran retaliates, that could be the sort of the element.
Yeah, it's the escalation that really is the problem or the main issue. It's not so much the loss of the 1.5 million barrels of Iranian oil. And you wonder about the impact of higher prices on oil on inflation, because that's been a dragon that has seemingly been almost slayed, and it could pop back up again. So oil is about midway through a range that it's been in for the last 3 or so years. If it moves up above 80, does that cause a big problem?
Well, especially, the US is in an election year, right? And energy prices matter a lot. I think it's around $3.20 a gallon, the national average. It's been coming down. So it's in a good place. So you would think that the US is probably encouraging Israel to perhaps stay away from that energy infrastructure. But prices, the market is nervous. The market is certainly nervous. It was hedge funds and money managers held the most bearish stance on oil at the end of last month. And you're seeing in the options market that people are repositioning. They're repositioning for the possibility of $100 oil. So, things are happening in the background there, and people are very, very nervous. And, a strike, it pushes prices up.
Yeah. All right, Ben, thanks very much for coming into the studios with us and shedding some light on this. Ben Sharples, Bloomberg Energy Commodities editor. Ed Gomes joins us now, CIO at SGMC Capital. I wanted to start off with China, since we just heard about that possible stimulus coming in the form of special debt. There are a number of people calling for that now, Ed. We've seen the market surge. I note that Nomura is out with a report saying a crash will follow. And basically what their report says is that you've got a lot of weaknesses that are built in from 4 years of the housing crisis. You've got a lot higher local government debt and escalating geopolitical tensions. Do you like that side of the story, or do you like the recovery side of the story?
Very interesting question. And we've been talking about China, for a few years as well, on the show. And I think what's relevant to assess is, does the government, does the party have the will to pull this off? It's always been, are they going to do the right things? And throwing money at the problem is not the only thing. And, to that extent, I think that's a good assessment by Nomura. You can't just throw money at the problem, because if you throw money at the problem and at the same time you damage confidence, whether it's consumer confidence, whether it's business confidence, in any form, then that's going to work counter to any kind of money that you're putting in. So you need to have the money and the support, yes, that's important, but you also need to do everything else to make sure that entrepreneurship, at the grassroots level, in the form that exists in a country like China, does flourish as well. And, that's going to be a very different form of entrepreneurship compared to the United States or other places that we know. But if the entrepreneur himself or herself is not sure about the lay of the land, not sure about what the policies are going to be, in the coming months or in the coming quarters, they're not going to invest. They're not going to take those risks. And that's what you need to see. So, fairly nuanced answer, and we're not trying to sit on the fence here, but money alone doesn't solve the problem. You have to address the confidence in the market.
So if we can agree that the eye of the storm is really the property market, and the similarity between what happened during the global financial crisis in the United States and the property collapse, or the collapse of investment in property, and in Japan's case, they were making investments in many jurisdictions, including the United States. So if you look at the problem that happened in the United States, if you look at that problem that happened 3 decades ago in Japan, has China been going to those histories, trying to understand the best way out of a situation, or they are flying a little blind here and not looking at prior playbooks?
One would expect that they are looking at the playbooks, but then they need to reconcile those playbooks with their system of functioning. Right.
Yeah.
If you look at the United States, 2007, 2008, a lot of companies were under severe duress, whether they were the banks or whether they were the property companies themselves. But Toll Brothers still exists. It trades as a healthy company. Lennar still trades. Pulte Homes still trades. Meaning, if I look at Evergrande, I look at Country Garden. Meaning, there's been no trading in those names for the longest time. So they're effectively gone. Right. The Japanese experience has been slightly different from the U.S. experience, and I would say probably somewhere in between the China experience that we've seen and the U.S., in the sense that they've taken a longer time to reconcile the losses and the fact that things had gone completely out of control, and we've got to let some things fail. So in the US, you take the pain on a lot faster. It seems a lot more volatile, but then you get to the news cycle a lot quicker. In China, it's been a long time coming, and not just the property sector. It's also the tech sector. It's also consumption. There was a point in time, and we've seen the reaction of Louis Vuitton, MCFB as the ticker, up almost 20 or 30% ever since these new initiatives have been taken by the Chinese government. Consumption itself drives the economy. So if consumption is a four-letter word, that doesn't help, right? So you've got to look at all of these things in the unique way that China looks at its economy. And I believe that they have studied the previous examples, but they're just finding their footing in terms of how they can express it.
It's a socialist economy, so I mean it's a different approach that they feel they have to take. Let's talk about the U.S. for a few moments, because there is still a debate about 25 basis points or 50 basis points coming from the Fed. We've had a lot of stronger economic data of late that would seem to suggest that only 25 basis points would be there. But I heard Ellen Zettner at Morgan Stanley and a few others arguing for normalization, that's still on the table, and 50 can fit that picture, even with stronger economic data. What do you think?
We're not as fussed about whether it's going to be 25 or 50. It's just that the sense is that the Fed has done a lot in the last couple of years with the tightening and keeping things tight for a long time. So, the path now for sure is lower. The watershed event of the U.S. elections, I think that's a really big deal in terms of just trying to figure out, what the makeup of the new Congress is and who's going to be the new president, because policy can go in multiple directions just from there. The other thing which we focus on is that the U.S. economy right now is not that weak, right? Mm-hmm. So you don't have a situation where, growth is falling off a cliff. Clearly, it's slower. But as you were discussing, just before the segment, the ISM numbers are pretty strong, and now the port strike's been called off temporarily. So, you're not going to have that drag. And the big deal, I think the biggest deal that I focus on is, this move of reshoring or bringing back production and manufacturing to the shores of the U.S. I think that's something which is going to only gain traction, only gain steam, and that means smaller businesses across the country are going to get formed in places where we've never seen them before. Part of that is industrial defense related, but part of that will just be support industries as well. So we're not taking a call on whether it's 25 or 50. If it's 50, it could be a dovish 50 or a hawkish 50. Markets will react, and we'll adjust to that. But clearly the trajectory is significantly lower. We don't even know whether we're going to get 7 cuts over the next 12 months. We'll just wait for the elections and get a sense on policy direction then.
Mexico is going to be a big beneficiary of that reshoring as well, away from Asia. I mean, very quickly, Ed, 30 seconds. I mean, opportunities right now that you like the most?
Can't get away from AI. You need to pick the stocks really well, but if you do that, there's massive upside. We're just starting this game.
Yeah, does it help a little bit that over the past 3 months or so, big tech hasn't done all that well? Does that help?
It does. I mean, I've been surprised recently when you see the S&P 500 outperforming the Nasdaq 100. That's a bit of a surprise just given the headlines, right? So yes, there's broad basing, but also the important thing that tech now, especially with AI, can help stodgy old companies actually get much more operational value out of these technologies to help them ramp up their top line as well as bottom line.
Yeah, that's going to be one of the most interesting things to study is how much productivity do we get in terms of gains because of AI. Ed Gomes has been with us, CIO at SGMC Capital.
Nick Schoenmaker. He is client portfolio manager at Drummond Capital. Nick joins us from Sydney. Thanks for making time to chat with us, Nick. We got to talk about what's happening in China. By one account, the effort on the part of authorities to provide maybe the biggest stimulus that we have seen since the GFC. I mean, how do you think this is going to play out?
Yeah, thanks for having me back on. It's certainly very topical at the moment after China being in the doldrums for so long. It's the biggest stimulus package that we've certainly seen since the pandemic. I think it's the biggest stimulus package that we've ever seen in nominal terms and the third biggest in GDP terms. So we've seen equities respond, as you know, very well. I think in Australian dollar terms, Chinese equities were up about 18% through September. I think given how hard the market has run, there's probably room for a bit of a pause. The market is exceptionally cheap in China, but PE ratios have always been low there. I think what we need to see is just do the measures sustainably benefit consumer spending, which has been extremely weak for a while. So we need to see the economic fundamentals having a sustainable uptick before I think we're going to see foreign direct investors back into the country on a more permanent basis.
Yeah, you've had the shock and awe moment, the whatever it takes, if you will. So as you say now, it has to show up in the data because, investors will be very nervous if they see weak data persist here, even with this stimulus. So what do you be watching the most closely?
So I think what we still need to see for us to really get confidence that we will see a broader movement of foreign direct investors back, we need to see packages that directly put a floor under the property market and get the local government debt to a sustainable footing, which is still totally out of control. So for now, I think in the shorter term, they've underwritten the equity market. But again, we need to see consumer sentiment coming back and the property market and local state debt on a firmer footing.
So have some of the analysts at Drummond Capital begun to kind of imagine how this may affect the Australian economy if things work out?
Yeah, well, it's helped our equity market have the best September quarter since I think 2019. Our materials sector was up 13%, and most of that was very late in the month. So iron ore prices pushed higher, commodities pushed higher, lithium pushed higher, and that had been quite weak for most of the year, where financials really had led the market's gain year to date. So higher iron ore is obviously good for our fiscal budget in Australia too. So it's definitely a good thing if China expands. There's more demand for iron ore, and it's started to be reflected in the prices. But again, we've had these little green shoots of recovery in China on and off for the last 3 years, but just all the issues with common prosperity, the market being seen as not being investable by the global community for quite some time. It's still just early days for us.
In terms of the global economy, if you get China moving again, and the U.S. seems to be on pretty solid footing, the City Surprises Index has really jumped over the past month. And I want to also remind everyone that there's a lot of stimulus from the Inflation Reduction Act and the CHIPS Act that hasn't really played out yet. I mean, these factories have not been built yet. People are not working there. So there's a lot of that's baked in over the next several years, and you've got foreign investment flooding into the U.S. I mean, this could set up for a pretty good period. Do you think so?
Yeah, I think there's some merit behind that. It certainly feels like we're in this soft landing macro backdrop at the moment. You know, we did see some signs of a weakening in the labour market, but overall GDP growth of 3% in the US. Our proprietary global growth barometer isn't showing any imminent weakening in the US economy. The fiscal spending still supporting growth as it has for quite some time, and employment in the state sector. So it is a time where it does feel like there is that soft landing backdrop. I think something that'll be very interesting to watch this week, which Wall Street's really focused on, is the non-farm payrolls. And just if we did get a stronger data point there, we could get like a bear flattening of the yield curve where short-term rates push a bit higher, and that could actually put the equity market under a bit of pressure in the short term. But we've got to see how that data print comes out today. I think there's about a 40% probability of a 50 basis point cut priced into November, so that could change the odds of that if it is a stronger set of numbers.
We've seen a lot of volatility in the Japanese yen this week. I mean, it's been head spinning, right? What's your sense of what's happening in Japan with a new prime minister, where the economy may be headed, whether there is still opportunity to invest in Japan?
There is. So JGB 10-year yields are about 0.87 now, I think. One of the things that we really keep an eye on with Japan is when those 10-year JGB yields get towards fair value, if they do. I think that's at about 1.5%. If we get to that level, I think we start to see some of the repatriation of bond money coming back to Japan because the local market becomes more investable. That is a big macro thematic that I think we still shouldn't forget about, because Japan's the biggest holder of US treasuries. They own about a third of the Australian sovereign debt market as well, and they buy a hell of a lot of structured credit, whether it's CLOs, asset-backed securities, securitized assets globally, not to mention high carry currencies in emerging markets. So we keep an eye closely on inflation and just where the 10-year yield goes. But for now, it's quite well behaved. So that's a key thing we watch in the bond market there.
Nick, thanks so much for making time to chat with us. He's Nick Schoenmaker, client portfolio manager at Drummond Capital, joining us this morning from Sydney here on Daybreak Asia.
This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.